Good afternoon, everyone. Thank you for joining us. My name is Jeffrey Asselstein from NelsonPark Property, and I'm joined today with Jeremy Marshall, who's head of Abu Dhabi for IP Global. Again, really glad you've all been able to join us today for our European property review. As we've done the last few of these, and appreciated the people that have been signing up, we'll go through quite a few things today. We'll keep it less than an hour. And as well, I appreciate that some of you may be having to leave during the period. We'll always send out a link by this time tomorrow with a video of today's recording, so you have that. Jeremy, just before I kind of pass over to you, I'm just going to put up a poll for everyone just to kind of get us started. Let's launch this. So a really simple, easy question is are you considering investing in Europe? So I would, if everyone can just join in and feel free to start putting your votes in. We'll just get a little bit of just to start to kind of get things warmed up, and then we'll move over. I was thinking, Jeremy, one of these times I'm going to have to get some music to play while this is happening to fill a bit of space.
And in terms of the for the slides there, have I got access to that now? Or?
Yes, I'll be sharing it with you in just a second. So let me just come back 1 second. So I'm just going to share the results for everybody. So about 63% was positive, looking to invest in Europe, with obviously 38 or so saying that they're not looking to invest in Europe at this stage. So that's where we're at the moment. Okay. So what I'm going to do, Jeremy, it's been a while since we've done this. So let me change presenter, and I'll pass this over to you. So it should now be in your hands.
Yep.
There we go.
Let me know. Yeah. Okay. Yeah.
Yeah, I can see I can see the slide, the PowerPoint slides.
Okay. Yeah. Okay, I'll put that into full screen. So yeah, look, I mean, there's plenty to talk about today. I mean, the whole point of this was to look at European markets as a whole, not being very specific and focusing down onto anything, but it was really just a kind of, given the current climate around the world, and people who are investors generally might be looking to secure markets or anywhere around the world, just to try and give a bit of a macro view really, and just start from the top and then kind of work down as to why would you or not look at any of these certain markets, and what is it likely to show then in the next year or two in terms of both safety and then returns, and are any of the markets which are historically safe and interesting ones, is that likely to change in any way? So I just want to give a bit of an overview, I suppose, for some of the guys who might not know us. I think some of the attendees today probably have come to some of the webinars before, might be involved, but I think most of the guys know NelsonPark locally there in Doha, but might not know IP Global. But just for reference, essentially, we are partnered with NelsonPark because we give that international perspective. We're a company who are 15 years old. We have bought and sold property in over 30 different cities around the world. As you see here, these are our kind of offices and where we have people based around the world. But yeah, we've bought up to $3.2 billion worth of property in that time. And so we are vastly experienced at that. And it just helps our clients be able to have that little bit of extra education. We can bring a property to them and be able to compare on a macro level what it means to, say, compare New York to Melbourne, or Berlin to Birmingham, and all these things. So if people really want to just think about how they're going to invest and how they're going to make money, it's a huge benefit to be able to really compare what different markets offer you. If you put X amount in 5, 10, 15 years, what's X amount going to come out, considering your finance, your taxes, and all this kind of thing. So this is where we bring benefit to our clients and through partnership through NelsonPark. But to give some kind of understanding of the business model, how we operate, simply, we are an investment company rather than an estate agency. It basically means we have It's all research led. We have a team who work and do the high level research basically, and pick out areas which will outperform over the next 10 years or so. We're effectively looking for kind of safety in big cities, where effectively is going to have the biggest amount of regeneration, where the supply and demand imbalances are most acute, and so essentially where natural pressure should take a market over time. And so we do all that. We then go and essentially buy properties from developers. We'll go and see who's building. We will then underwrite and de-risk the developer and onboard the risk ourselves, but it allows us to effectively take a high margin from a developer and then be able to offer our clients, you guys, better rates, basically. You know, we can sometimes give discounts to developer rates, but bring properties to market early. And you know, everyone knows who works with us, that everything we brought to market is something we're taking financial liability on. So our risks are aligned with all of our clients. But usefully, what it allows us to do then is to globally, we can help our clients with every stage of the process. So it's not just research. We can do literally everything physical in the process. So we've got lawyers on panel. We've got mortgage brokerage to help get finance. And then we've got lettings teams on the ground who will find the tenants, manage the property, and help sell the property in future. So it allows our clients, whether it's in, you know, head office in Hong Kong or in Australia or Africa or Middle East, anywhere, to be able to sit in their offices, make informed decisions, and be able to be handheld throughout the entirety of the life cycle of owning that property. So that's just something about us, so you understand where we're coming from and why, you know, I will talk about, you know, such a macro view of markets and really what makes sense, because effectively that means safety for everyone. You know, if you get something right from the beginning, you know, with slight ups and downs of markets, you'll be able to ride it out for how long a property should be held. That's the right thing to do. So property in 2021, you know, why people are looking at what's happened in the last year. Effectively, the reasons why property are always successful have been compounded and exacerbated. So the fact that it's a long-term asset and it's illiquid, which a lot of the time you hear in a negative connotation with property, but that's the very reason why it's not tradable very quickly, and therefore that's why people like it as a long-term safe asset class. And so that's what we've seen a lot. You know, when COVID really hit last year and the stock market really had big tumbles, we saw a lot of institutional money, a lot of the kind of the bigger money, push back to the long-term established market. So not necessarily property everywhere in the world, but developed market property. So, you know, we had a lot back into the UK, a lot to Germany, a lot to the bigger capitals you might have expected to. And that in itself gives a lot of kind of insulation and kind of extra buoyancy to markets. So, you know, when times are bad, you can still actually find growth and not just kind of maintaining and, you know, holding. So when we're coupling that with leveraging, you know, taking a mortgage, that means that even if we can find, you know, fairly modest capital growth on properties, you know, 2-3%, when you're leveraging it, it means you're compounding your returns. So effectively, you know, leveraging is being able to use a bank, you know, a very big institution as a business partner in this business, buying a individual or multiple properties. And so, yeah, but you get to keep all of the profit in terms of the capital growth over a period of time. So it's very, you know, no really other asset classes where you can, you know, borrow and take a partner like that in with the game with you. So the other thing with property markets, which is always hugely affecting, is market sentiment. And through a mixture of government-backed incentive packages and different measures, basically, to kind of protect each individual country's economy, we actually still have a very sentiment and strong outlook for property markets in the markets we're looking at, particularly in Europe. But yeah, like it's all the reasons you'd expect it to be. That's why it's still working very well. And if nothing else, even if you are a stocks and trader, in that respect, it's a good diversifier. Personally, I kind of tend to think it shouldn't all have all your money in property, but you should have some of it. You know, if you're going to be planning for either retirement or building your portfolio, you know, diversification is a big play. So, considering everything that's been going on, what, if anything, is changing at the moment? Should people be changing direction? And what, considering what's happened, is kind of turning our heads potentially? So, you know, our company philosophy, my philosophy, first would be safety in times like this, and that doesn't necessarily mean going to the most boring low yield markets, but it does mean just picking very, very carefully and not necessarily chasing dangerously high yield. So yield on a property is a direct reflection of risk. And so in, let's say, established markets in Europe, where we're mostly looking, I would say any rental return yield up to say 6% is quite a, that's healthy in any developed market. Anything above 7% or above starts to be a little red flag about why is it? Is the area too poor? Is it less in demand? And so just buying property for the rental return in that respect could cause you a lot of different problems in the long term. Like it might be even problem tenants, not necessarily finding any capital growth there. And so it's a time to try and find that right balance. You want good enough yield to keep the property healthy, but more than anything, a strong yield, I would call it, rather than the high. Something which is always going to rent and not necessarily at extraordinarily high percentages. So discount wise, I kind of fairly, I think I've had a lot of people ask me over the last year or so, what's happening in terms of are there good kind of discounted, basically distressed deals on market. And I think what people have to remember is financially this isn't the same as the GFC, the last financial crisis before, and that was a credit crunch in respect. The banks lost their money, and so there was almost next to no lending out there effectively for property markets, and so they all contracted, and that's why we had some people in distressed situations trying to sell, and effectively that really hasn't happened. Yes, there's been some extra unemployment and so forth, but there's been big stimulus packages. It's not allowed that to happen, and the banks don't have that same issue there. So we, other than literally the some resale on the high street where there's been problems there, but that's not really a COVID situation. That's more of a kind of cultural, generational change. And then maybe obviously some hospitality has had a really tough time of it the last year. But, in the residential sector, that's actually been a remarkably buoyant. And so when I put what to avoid there, it's not really about, certain markets or areas, but it's about now's probably not the time to betting on, luxury and tourism, for might be able to get a headline discount maybe, but it's the time where we really don't know what that's going to look like over the next couple of years. So it is quite a big bet there. In terms of what are cities looking like? Because again, I get asked the question fairly regularly about what do I see in the kind of short-term future. Are people, as we've seen in the press, going to be moving out of cities and setting up in the countryside with their families in bigger houses and will work remotely? Short answer is not really. No, don't really expect to see that. We did see a boom of properties outside of cities and price rises around there, but probably what's happened there is always there is a generation or so looking to upsize, get bigger properties, move out with their families and start that kind of living. And particularly in the UK, there has been a very quick push to get that done quickly with some of the tax incentives they've put in place for stamp duty, and everyone sitting at home, frankly, maybe in apartments with a family, thinking maybe we need a bit more space here. So, but fundamentally, big business isn't going to be suddenly diversifying their offices, very, very sporadically. They want to make it cost effective. There's a huge amount of money and effort and time from everything put into these city centres, and frankly, if you're remotely kind of in need of a job, or there's times where exactly find it, you're going to want to be where the jobs are. You're not going to put yourself in the middle of nowhere, basically. So offices are safe. People might downsize slightly, but people still need people are human. High streets, that will change, but that again, like I say, that's not necessarily COVID related, but it's effectively moving to more kind of luxury and service orientated rather than your traditional like hardware store and a high street. We shop differently, effectively, as that. But city centres, people congregating together, we're still service industry led. It's if anything, that's going to be more of an acute thing in the medium to long term. So that's the kind of COVID view. And now I have to say I've got some some brilliant data, and us, property geeks, well, that's what we thrive off, really. And just, you can imagine with everyone sitting at home and all the consultancy firms over the last year, there's been some really good stuff coming out, people crunching numbers. And so hopefully you'll find some of this very interesting. So what we're going to talk about is, on a macro view, some of the different countries, and what generally the market expects to happen, and fundamentally actually facts of what has happened recently. So here, just out of interest, considering we're largely going to talk about kind of Europe, but these are capital cities around the world, or larger cities around the world, and what the 2021's price growth is going to look like. And I think it's quite interesting to see, considering like some of the traditionally big players like New York and Hong Kong, which are some of the big priciest price per square foot in the world, they're looking at pretty deep drops this year. But say London, which again is equally as expensive compared to others, is seeing a pretty healthy 2 to 4% growth expected this year. We've got some interesting ones in there, like Moscow or Seoul is very high, but they're kind of probably specific different reasons why they might be this year. Sometimes starting from a low base, and sometimes having some incentive in place. But the other ones we want to look at, which people might consider in Europe. Paris, that's not looking to be a brilliantly great year. It's not a market we're interested in. Amsterdam, again, pretty flat. Berlin, extraordinarily interesting, 6 to 8% in capital growth in this year. That's really a great performer, and actually that's following the trend it's been had on for the last 10 years. So we'll look at that in much more detail in a bit. But hopefully you find some of this interesting about where generally the property world is expected to be.
Just as you finish that slide, I'll just say, as a Canadian, I noticed there was no reports on Canada, but we'll make sure we have one for the next slide, the next go around.
But you can blame Savills for that. That was actually their data.
Well, exactly. But you may know I have an Australian wife, so you had Sydney looking very, very prosperous. I see, with huge expectations in Sydney. So very interesting. So sorry to cut in, but we'll get on Savills for next time.
Yeah, exactly. And we're here. We'll just narrow down to Europe a bit, and please do jump in with questions like that. It's nicer for the flow to hear someone else's voice just than mine. But but as part of this, I mean, so everyone knows that we as a company, as investors, we pick our markets in things we're essentially taking risk on. So what we have on offer is effectively what we think people should buy because we're buying it. So people know currently what we have on market is UK and a range of different cities, Germany, specifically Eastern Germany, and Portugal, and very specifically just Porto and Lisbon in that market. So when we look at these stats, we can talk a bit about why we've picked those ones and why actually maybe we haven't picked others. And particularly I say that on this slide because Ireland looks very, very attractive compared to its recovery. So, in terms of economic growth, effectively what we're looking at here is the 2019 baseline in red line, and where each country is going to be getting to recovery levels in terms of their economic growth. And so largely what we see here is actually a very positive position that, Germany, UK, Netherlands, and almost Portugal there, basically getting back to recovery in 2021 to pre-COVID levels. But some then may be dropping away slightly, like Spain, Italy, not being a bit slower to do it. So it's just showing actually what's happened, what the stimulus packages have had an effect on. And particularly, I should mention Ireland here, as in why maybe we're not investing in Ireland. We did actually, and we would in theory like to, because there are interests there. It's not a very diverse country in that respect. If you went to a property market, it probably would be the big city, Dublin, maybe Cork. But Dublin actually has been very successful the last few years. And so prices, it is difficult to find value. But as a whole country, their economic growth is doing quite well. So it's a difficult kind of balance to say, well, do you then go and buy at the prices that Dublin currently are? And the second problem we have is available finance for anyone outside of the country is very difficult to come by unless you have a Irish passport. So fundamentally, if we can't have our clients leveraging and investing in the philosophy we like, we won't do it. So maybe in future, depending on the banks and on their mortgages, basically. So foreign direct investment. How much money is coming into the major countries around Europe over the last 3 or 4 years? I expect some of this might surprise you. United Kingdom, that's always either number 1 or number 2. It's probably disproportionately lower than Germany currently, mainly it's been going through a Brexit cycle, and people are basically, well, there was a lot of money coming in because the pound was cheap, but actually people are, have been holding and pent up demand, waiting to kind of when the Brexit was formally announced, and we have seen this a big surge. So, but the really, standout performance we're seeing here is Germany. Over the last 10, 15 years, in terms of foreign interest, it's ramped up hugely. So being the fourth biggest economy in the world, it does get an awful lot of money pumped into it. And then as a sliding scale, we can see there how maybe France and Spain compare to each other. Ireland probably outperforming in terms of money coming in. That's very much to do with the tech industry, and the low corporation tax they've given there. So there's a lot of companies been putting money there. That's probably a 2 or 3 year anomaly, but it's in a healthy place. Portugal, bottom right, you may ask why then are you buying into it if it's so small. But bear in mind, we aren't buying into all of Portugal. We are buying into Lisbon and Porto, which account for 75% of the entire GDP of the country. So a lot of that is just Lisbon and Porto. And so for property markets themselves, they are very interesting and have very good growth projections.
I find the figure. I find the figures for Germany fascinating. I think I'll put my hand up as one who is probably a bit who's probably more UK centric and often didn't appreciate, and I've only gathered this appreciation the last few years, frankly, just what a powerhouse that Germany is. And so when I see those numbers of the amount of FDI hitting Germany, that's really impressive. Really, really impressive.
Absolutely. Look, and in terms of just general property markets, you're right. And the UK is still probably the global #1 property market for people to invest into. It is a long-term safe haven status, and people know that, and people know what they're getting, and it's very, very reliable. So that's not likely to change. And that's largely on a residential property, and Germany has had commercial and property interest for quite some time, and its residential interest is probably started to happen significantly in the last 5 years. And so in terms of other reasons why these makes it safe or attractive, the unemployment rates, clearly they've gone up in this last year, but actually what we're just looking at comparatively is UK and Germany a lot lower than others, but particularly again this shows us why we're not investing into Spain. Madrid or Barcelona in theory could be quite interesting markets, but Spain's unemployment rate, in the not too distant past was 27%, and that's pretty extraordinary. And that was 55% youth unemployment, and it's still high youth unemployment. So what we don't like about that is the next 10 years, who are the rental generation, who's effectively going to be the people bringing money into market, and so that's a worry for us. And it's a quite high carry cost for property, but hence why UK and Germany really are front runners there. Government debt to GDP ratio. What we see here, particularly for Germany, they're in a very healthy financial position, as you might imagine, very German, very ordered, very sensible. The UK, here I can see kind of, okay, well, actually their debt's going up a lot. Partly this is to do with, very recently in the last budget, kind of announcing an extra, 200 billion or so in terms of stimulus package. But they do have their global position to think of, and they will be spending more to effectively secure their long-term standing. London's not really got much risk in terms of losing its financial capital status, but as a country they want to make sure that's going, so they're going to make sure it's equally interesting to invest and to keep being around in the UK, and so they're going to make that interesting for other countries to come to. So for Germany, everyone who's investing really should be kind of keeping their eye on currency. Us based out in the Middle East, most of us are pegged to the dollar. Appreciate some people on the call aren't based in the Middle East, might be some elsewhere, but euro and the pounds are both relatively cheap compared to long-term averages at the moment. So the markets we're looking at, and this can count for anywhere in the world if you're buying into. The currency is a serious consideration. I wouldn't necessarily kind of try and future predict it, certainly not in the short term, but if you look at long-term averages, that's actually a fairly safe thing to kind of predict on. So you can know that either you have no risk or you actually have a decent possibility of making money on the currency over that period of time. And certainly pounds still look cheap. They have recovered since Brexit was announced and completed, but yeah, again, euros 5-10 year lines, they're looking cheap. Lending. Not everyone, I suppose not everyone on this call as well, will want to borrow. But in terms of investment philosophy, it's an individual one, but certainly kind of we would say that if you're buying into a secure market, which you can pretty comfortably predict capital growth over a 10-year period, leveraging will make you more money than just buying something for cash and taking rental income. So what the banks are offering, and all the European base, the base rate and the Bank of England's base rate are 0 or 0.1 at the moment. So the lending is historically very, very, very cheap. So here is what we can offer, or the different banks in these different countries can offer in terms of lending to expats specifically. So in England, it's 65 to 75%. I did have a client this last week agree an 80% mortgage, which is almost unheard of for something in Manchester. But he was buying through a company structure. But generally, I would advise people to plan on 65%. And because that's probably, there's more banks offering that than there are offering 75. And if in the time you bought something and to the time it maybe completes, it's at that change, you don't want to be needing to pump up extra cash. So plan for 65 and let's get you more if you want it. So, but the interest rates are the best they've been for the last 10 years. We've got some banks offering under 3%, and then some, if you're buying in a company structure, it is more expensive, can go up to like 5%. Germany, probably the most secure system of the mortgages, in that you will get your mortgage in place at the time you're putting, even before you put your deposit down on the property, so you can be secure in that and have an agreement with the bank. So there's literally nothing in terms of risk there. 65 or 70% are the top rates that the banks will give properties there. In fact, we pre-vet our properties with the banks before we bring them to market. So we literally can tell people exactly what their lending is going to be on an individual basis. And interest rates can vary from as little as 1.4% in some cases up to 3.2. And particularly that 3.2 one, that'll be a 30-year mortgage, and we can fix 3.2% for 10 years, which is very nice to know, what your cash flow is going to look like for a long period of time. And so it doesn't matter what's happening with interest rates over the base rate from the European Central Bank, what your cash flow is going to be like. And that's quite a rare commodity to have that security. Portugal, that probably one of its main interesting points, considering we've got healthy growth projections, we can find mortgages for under 1% there, fixed for 5 to 10 years, with long-term agreements for the mortgage. So, that's basically giving money away, and that's literally from a couple of clients I had in January. Got pre-approved for their 0.8% for mortgages there. So that, in anyone's book, has got to be incredibly attractive, fundamentally, just on that. So I'll now go into.
Sorry, Jeremy, I'll just chop up in for 2 seconds. The ex-banker in me, I was a banker for 18 years, cannot get over the fact that you can fix in Europe 10-year money at that rate for an expatriate. When you add in that low of a rate, that long a period of fix for an expatriate, that's incredible. And as you say, if you're looking at your yields and looking at your returns, when you're able to lock in that kind of money for that period of time, that really boosts your IRR for the any kind of project that you're looking at. Really makes it quite compelling. Hugely,
exactly. And this is investing into a low risk asset class. It's super attractive. Literally, been in this game for 10 years and we've never had rates as cheap as this. So if you can buy into something which is, nothing's ever a sure thing, but if you got markets which the fundamentals are propelling it that clearly, to borrow this cheaply is super attractive. So yeah, UK, as you say, probably the most famous global property market, and still very attractive. So what's happened in the last year? Stimulus packages put in by the government, and we did have a lot of pent-up demand, basically from particularly the local market, kind of not necessarily transacting so much since Brexit was announced up until things got solidified. Now, actually, beginning of last year, the major consultancies, when COVID was kicking off, kind of ranged from expectations of maybe 7 to 10% of macro price drops in market, because they really didn't know what's going to happen. But what with the kind of government stimulus packages put in place, furlough scheme allowing people not to be put out of their jobs, and stamp duty exemptions, so there's no tax to buy the properties. We've seen a huge demand, both locally and from foreign investors. So we've actually seen it on a country level, prices increased by 8.5% over last year. So you can see clearly that it's still a very attractive market for everyone, and thankfully we'll see in a second actually in terms of stimulus ongoing is likely to have an extra boost. But I just wanted to as well put in here about which markets we might be interested in, and this map shows UK in total. I would say, I could have made this up in terms of tiers for the cities, but London being tier 1, just purely in terms of the size of the city, its importance globally in terms of an economic powerhouse, and actually the general pricing, of course, there. And it has been come off the boil since Brexit. It had a good 4 years or 5 years, maybe even, of being kind of, a lot less transacted, and certainly prime areas, prices came down. But actually what we've seen is a lot of stabilisation and a lot more people buying. You can see, there's a lot more people advertising London property, and certainly, particularly from foreigners, but, there's a lot more money coming into the market again in London. And I think that is a lot of a mitigation, a risk play for, their global assets to put something into a market like London again, which it always is. Tier 2, Birmingham, Manchester, the second biggest cities. Birmingham is the second biggest by some way. But Manchester and Birmingham, similar kind of economy sizes in the UK, and probably therefore pricing. And then tier 3, Leeds, Liverpool, Newcastle, Sheffield, decent sized cities in their own right. A lot of money going into those, both kind of public and private, and so very good reasons why we're seeing kind of higher yields there, but actually still good growth. So those matched with then opportunities we can find on what HS2 and Crossrail are at the bottom there. They're massive infrastructure projects. Crossrail is a rail line going from east to west London, which has been being built since about 2007 and is due to complete. Was due to complete actually last year, but it would probably complete then next year when they're going through the final testing stage. That'll be a big difference to London prices overall, as you're able to kind of get across the city a lot quicker. And HS2 High Speed 2 is, again, the government trying to improve infrastructure, join the north and the south up, diversify our risk away from just London. So that's a high-speed rail which is going to link up initially Birmingham by 2026, and then go up north to Manchester, Leeds, and Liverpool way, and in theory actually up to Glasgow as well. So any infrastructure project, massive in terms of why prices are going to change. And we can talk about it more, but particularly with Birmingham initially, that's going to be a huge driver in price growth. Now, budget. You've probably seen it all over LinkedIn or in the news and so forth. No one can stop talking about this last week, but lots of very nice things were announced in the budget on the 3rd by Rishi Sunak, the Chancellor. And these are some of the highlights for the property market and why actually it's going to be very nice and give a bit of support. So the furlough scheme has been extended to September, which basically means that a lot of government support for companies and their employees. So they'll be paying a certain amount of the wages. And effectively what this means for the property market is a lot less unemployment. That means there's probably like almost 1 million more people in work than the original economists were considering there might be. So considering the extraordinarily successful vaccination program that the UK has got, and being above mostly any other countries in the world, they literally have got over a third of their entire population already vaccinated now, or at least the first one. This means that they've got a program and a plan to hopefully get a lot of the UK back to certain parts of work by April and May, and then June. They're pretty much going under a lot of pressure to be kind of fully back to normal life. So this means hopefully by September, a vast majority of people will be back into work, and in the furlough scheme could even get extended on a much smaller basis at that point. Going to be a lot less impact to the government there. So unemployment massively reduced in its impact. They've also announced 95% mortgages for first-time buyers, which means that a lot of locals, this isn't for investors, this is for people buying and owning their own property. It means that they can get, property in with a much smaller deposit. It means get on the ladder, and that means so many more buyers in the market, which helps us as investors as well. Stamp duty holiday is the big one, which everyone's been talking about. They effectively kind of rubbed out acquisition tax for property up until was 31st of March, and we had a big run on property to try and get in for that. They have tapered it now, so they've extended it until June, at the headline level, so up to £500,000 no stamp duty, and then up till September of up to 250,000. So it's allowing everyone who's currently in the process, and probably if you're quick, to get in. Well, certainly if it's 250,000, you've got a good amount of time to get in and not have to pay any of the government acquisition taxes, which is a fair few £1,000s, up to £15,000 in tax savings actually on the properties. So that's enormously welcomed by the property industry. Corporation tax, there was a lot of talk for it being risen this last week, but basically they've deferred it and said it will rise from 19% up to 25% by 2023, but only for larger companies earning at least £50,000 profit. So very fair, very even, and actually a decent length of time to look into it. So property investors who are buying, the occasional individual property in a company structure, probably not affected too much. It may well change. Big property investors might own a lot of property in company structures, because a lot of the incentive of doing that was to have their income tax reduced, and this negates some of that. But look, I mean, that's a conversation we can have for individuals about how people should buy long term. A couple of other things. Personal tax allowance is frozen at £12,500. So, and particularly anyone with a UK passport, and some Europeans will be able to get any income tax, the first 12.5 grand tax free. And so that's been frozen for the next couple of years, basically. So that's still in place and helpful for people. And interestingly, lifetime pensions allowance has been frozen. And so actually, there will be then people with a little bit of excess there who go over. It means that where they'd naturally put that excess into a low risk asset probably means there's more people putting money into property in the UK. So there's a little bit of extra boost there, likelihood. So a lot of very good things for the UK property market, and particularly for the next 6 months, we're likely to see a big surge again. So for some people on the call, to make it a bit real, these are a couple of examples we have. I've just got two here. This is High Wycombe, not necessarily a town you might know, but this is essentially a London investment story. So it's a commutable town. It's a 160,000 person big town just on the edge of London, basically, and it's a commuter belt zone. So why we bought this property and why we like it is, A, it's complete, so people don't have to worry about mortgage. They can get set up now. It is delivered this month, and you can be into London within 28 minutes. But being able to buy a property at 250, even 2 beds at 350,000, that is a lot cheaper than you get anywhere inside the M25. And so value and good high rental yield and expected capital growth, that is a very attractive investment case. Second, here for the UK, I've put this one in Birmingham, which is probably one of my favourites in the last little while. Birmingham, like we said before, one of the major benefactors of the HS2 line in the near future. It's the second largest city. There's already been a lot of money flooding into this city over the last 10 years as big London companies starting to migrate some of their offices there. But we've brought just a project to the market, which is just incredible value in terms of it's cheaper than almost anything, a new build that's been launched in the last 2 years in this area here. And it is within 10 minutes walk of the train station, which will take you back to London when that's delivered. So, from £250,000 between 1 and 2 beds, very, very central in a very high spec property. There's no wonder that the capital growth expectations are some of the highest in the country here. And the supply and demand is some of the worst, affected in this area here. Now, Portugal is our second market. As I said, Lisbon and Porto account for 75% of the GDP. Why we like this market is it's a market which has very cleverly changed itself a lot since the global financial crisis. It was in financial trouble. It did get a big bailout from the IMF, but instead of agreeing to the harsh austerity measures trying to impose it essentially had an aggressive fiscal policy and decided to spend its way out of the problem, and it's worked extraordinarily well. So it's changed a whole ethos from manufacturing and tourism to tech, to service industry, to startups, to education, and it's flooded money into that. Jobs, unemployment rates, absolutely dropped down. And those two cities particularly have been very successful, and they've got a lot of infrastructure ready there to help propel it for the next few years. With those then cheap interest rates in those markets, that's really compelling. And it's not our speciality, but also as a country, it does have the golden visa opportunities there for it. So if people wanted to buy a property and get a European passport, then it does have that if people want to put in either 350 or 500,000 euros to get into that. Most of our clients will buy a property and leverage with a mortgage, but if you want to take a visa, then you have to buy cash and put that much money into the market. And as an example, this is a property we have on market right now with which is completing this month again. It's a high, nice year one. We got 5.5% guaranteed rent for a couple of years there. It's very, very well priced for the area. It's in a very attractive property. It looks, you see here down over the river and the cathedral and so forth in the historic quarter. And it use the kind of property parlance there, but it's a deal basically. I couldn't say better than that. It's just a very good price per square foot for the area it's in, basically. So yeah, if Portugal appeals, by all means, I'd be happy to speak at length about that.
Just give me a quick idea, Jeremy. What's sort of starting price in that property?
Oh yeah, sorry, I put that there. There's actually 1 and 2 beds varying, considering it's actually a very prime Lisbon one. It's from about 360,000 up to about almost 600,000. So considering you might take a 60-65% mortgage on it, those cheap rates, you might need anywhere from 150 to 220,000 euros or so to get into that, and easily enough rental income to cover all your costs and then give you some rental income after that. It's but yeah, the growth expectations on it are very good, particularly considering the headline price we've got.
Yep, excellent.
So yeah, and lastly then, in terms of markets, Berlin and Leipzig, Germany, sorry, we are very much interested in the eastern side of Germany. Largely, if we took the historical context, it's because, as you might know, Germany was separated, after the war, and so it was half controlled by the Soviets, half controlled by European markets, and so Berlin particularly was very much divided city with the wall down there. So when the wall came down 30 years ago, what we had left then was a market which hadn't had any of the major industry propagated in it, which all went to Western Germany, and so we had a bit of a vacuum, and everyone kind of left after that and tried to move west where the money was. But actually, Berlin has always been the cultural and political heart, and by quite some distance, the biggest city there. So with what we've seen over the last 30 years as a kind of filling the void, and so prices that were, they were originally about a quarter of what the Western cities were, but for the capital of Germany, essentially the prices are a lot lower than they should be. So we've seen double-digit growth in a lot of areas of Berlin for the last 7 or 8 years, and coupling that with major infrastructure improvements. They've got their first proper international airport only just last year. So for the first time, people from Middle East and Asia can fly to Berlin, the capital of Germany, whereas they had to fly into Frankfurt before. And so that alone it makes a huge boost to the economy. But considering then we've got this kind of big driver of growth for Eastern Germany, one of the big advantages of buying in Germany is the fact that if you hold it for 10 years, you don't have to pay anything on the growth in terms of capital gains tax, which most of other markets will. So, we had 8% growth last year in COVID times. And so if we got even half of that averaged out over 10 years, not paying any tax on that when you hold it for the 10th year, it is an enormous boost on your full return on equity on a property investment. Now,
it's true. For those based in the Middle East, we're sort of used to zero tax, but it ain't that way the rest of the world. So when as you say, if you can hold, if you're a long-term hold, then that's again that really, when you truly look at where your IRR is, again on a post tax basis, that has an incredible boost, particularly when you look at other European cities.
Yeah, no, absolutely, and to give it some context here, I think people kind of understanding what Berlin is, and to be honest, I kind of understand that some people as well, kind of emotionally, Germany wouldn't be the kind of the first one they go to. Maybe Portugal is kind of like kind of down by the coast. Sometimes it's a bit attractive, but fundamentally, when you see all these stats, it's such a a low risk market comparatively, you know, and seeing just how big Berlin is, you know, in terms of economy, in terms of population size, and where we'd see it going in the next 10, 20 years, you know, it's very, very encouraging for that safety level of, you know, where are the renters, where's the money coming from, this is it. So, you know, Berlin's, you know, will have 4 million people by 2035, but considering its size, what we see here is actually the population growth is outperforming for most of the other cities, other than, do we see the bottom right, Leipzig, which is, Leipzig is basically mini Berlin, a lot of people call it. It's a city an hour south of Berlin with a lot of the same investment fundamentals, but effectively half the kind of price per square meter and a slightly higher yield. So, you know, it's the kind of young upstart, but with exactly the same kind of driving forces as to why, you know, success should come. So, number of German households per income band, kind of strange stat, but this is effectively looking at just how affordable price is going to be and how much more money the locals are going to have there. And so, what we're looking at is you know, an annual income for your average Berliner going from 0 to 35,000 bracket in the year 2000 was a vast majority, and by 2035, you know, it's coming from Oxford Economics, these stats, we're expecting almost no one to be in that bracket, and actually the people in the kind of 100,000 plus bracket is risen by 195% over that 20-year time frame from now until then. So yeah, it basically means the amount of equity, the amount of liquidity in market is it just shows how safe this market will be over the next few years. Yep. German cities by GDP growth, very similar story. Both Berlin and Leipzig, all of them, frankly, are actually very, very healthy numbers, but the ones we're actively investing in do outperform and compared to market average. So to make it real, then, this is the project we have on live now. We do have a new project actually launching on Thursday in Berlin, and then there'll be something again in Leipzig in a month and a half's time. But Berlin is what we have now. Effectively, these are studios in an area called Mitte. Mitte means middle. This is the central borough district of Berlin, which is the embassy district. So in this picture, you can see in front of you, right directly ahead of that tower, that's like Alexanderplatz, one of the kind of job centres. Literally 2 minutes walk is the Chinese embassy from here. You've also got the Australian, Brazilian and Dutch embassies just around the corner. And this is sitting in a cultural kind of path as well. There's kind of both theatres and, you know, exhibition spaces just on this same road. But we're walkable and bang in the centre of the 4 major employment hubs of the city in this area. But we're able to get into buying and prices from, it's actually slightly out of date. The 250,000 is the cheapest unit still remaining, up to about 340,000. So, you know, considering you can guarantee getting 65% lending on most of the units here, it's, you know, it's a very good price and it's a very good position to be able to buy into this city, which we can see, you know, why it's going to be doing so well over the next few years. So that information-wise, thankfully, probably if you're thinking, yeah, that's mostly it. But I just wanted to put that in there, just in terms of, you know, it is a modern world. We're all very connected now, and both Jeffrey and I are very easily accessible to talk about this. And frankly, I would thoroughly encourage you, if you either want these slides, let us know. But really, just for any questions on this, or any just you know, challenges or anything, or just, you know, tell us what you're actually interested in, because lots of information is very easy to share in terms of very detailed Excel cash flows, in terms of, you know, costs and 10-year projections on returns. Of course, everything like floor plans and brochures and so forth. But yeah, we can do everything remotely as well these days. But that is largely it from me. So I don't know if anyone has any, or Jeffrey, you have any questions on it?
I'll just add a couple of things before we move on. And I just did a quick calculation with my phone, frankly. When you talk about 250,000 euros, appreciate that the majority of our people online right now are from either Qatar or the UAE. That's just about 1.1 million rials or dirhams. Obviously, both are together the same rate. So it's just a little bit over 1 million rials, 1 million Qatari rials, or a million UAE dirhams. So when you put that into context to other opportunities you may see in our local markets, as it were, it kind of gives you an idea. So, you know, when you're looking at what else is available, comparing it, 250,000 euros is just right around 1 million reals, which is interesting. So when you just in the last little bit, I found the discussion on Germany particularly very interesting, and as I referred to before, I tend to be a bit UK centric, so I'm finding Germany interesting. Hopefully, I'm not catching you off guard with this question, Jeremy, but my understanding, if you look at Germany, is it's historically been that's the right phrase. As a Canadian, we all want to buy our own homes, and I know it's kind of like the American dream, and I know in the UK, obviously, it's a thing that everybody wants to buy their own home. Again, if I look at Germany, my understanding is the population is really a population of renters. In other words, and I think the positive thing of that is that it creates quite a strong rental pool for investors, but also that is shifting, and which would also is expected to have a positive move on the market. And again, sort of put you on the spot here, what are your thoughts on that?
I mean, yeah, like a lot of mainland Europe, you know, like you say, like Canadians, British, Australians, South Africans, a lot of them are kind of buyers, you know, like people who like to own their own home, you know, so you'll get vast majority of families will eventually try, and that's our aspiration, is to buy. Whereas mainland Europe, yeah, largely it's been renters. So about 10 years ago, you know, we were talking about almost 90% of Berlin as being renters. But, you know, within 10 years, we're about 78% are renters. And that's still a lot of renters, which is a very healthy market. But, you know, to ensure you're always going to be able to have someone there. But it's a huge swing as well, you know, and that's largely come with West capitalism, I suppose. You know, like Germany, you know, in Berlin particularly, has been very successful. But the cost of lending has been extraordinarily low. You know, the lending we show today for expats is very low, but for locals there, it's been, you know, next to nothing. It's been, so being able to get property, which was and still arguably is quite cheap compared to kind of global standards, people know that's a good pension policy. You know, like, let's put our money into that and believe in it and hold on to it for, you know, for 20, 30 years, and we're going to secure ourselves for our retirement. So there's a lot of young Berliners and families and so forth who've been, you know, buying into property in that time. And, you know, it also really just helps us with our buyers who are going to be getting in and then selling in 10 years time. A lot of the time, it's that extra liquidity to be able to sell the asset when you need to. So yeah, you know, it is still a very strong rental market, but it's changing actually.
Absolutely. The last question I'm going to ask you, just I'm going to shift you back to the UK for a moment, and hopefully I'm going to ask you your last budget question. But I have a feeling you get more. One of the points you brought up from the budget was the support of first-time buyers, being able to borrow up to 95%. Now, your average person on the line might say, "Well, that's great, but that's not really me. I'm not you know, UK national. I'm not in the UK. That's not really me." But why that's important, at least in my personal view, and I'd love to hear your comments, is for the market to grow, you need that first-time buyer in the market. You need that first-time buyer getting on the property ladder to start the rest of the chain. And you're more of an expert than I am on this, so I'd really like to hear your thoughts. Is this am I in the right direction on this, or what do you think?
Yeah, I mean, everything's supply and demand. In the end of the day, that is the backbone of anything to do with property. In the end of the day, and the more people you have in market competing effectively to buy those properties, the better for us who are investors in that respect. You know, we want the pressure on both renters, you know, that price and the capital values to be going up. So the more people who are able to buy, the better, full stop. So so yeah, I mean, that, you know, that it goes, like I was saying about Spain earlier, you know, like, because they've got such an unemployment problem, and particularly youth unemployment, you want those youngsters, you know, you want people to be getting onto the market as well, you know, be getting into the game. So because they can't, you know, we're kind of less interested in it. So yeah, I thoroughly agree with you.
Very good. Now I'm going to just finish off just in the last few minutes here, if I can do this quickly, just before people sign off. So a bit of a leading question for everybody, which is, if you're looking at investing, what would your time frame be? And just so you know, we don't track responses. We're not sure exactly who is responding to what. So we're not tracking you, but just it's always good to get a feeling for what people are looking at. So is it something for people that are looking to invest? Will they be looking within the next 3 months, between 3 to 6 months, or greater than 6 months? I'd just be interested to see what people's thoughts are. We have a few kind of responses coming in, and I'll leave it just for a few seconds before we move back.
Just my perspective on that. I've seen a number of major consultancies asking the same questions basically to their kind of large pools, and it's surprisingly high. I'm not sure what we're saying today, but you know, in terms of investors who do invest in property, you know, most of them come out at 80 to 100% of those who consider themselves a property investors. You know, are actively looking for this year is generally what we've seen kind of across the platforms I've seen in the last, you know, 3 months, let's say.
Interesting. Now, this clearly is not scripted, so we actually have the reverse. So literally no one of the people that are remaining on the call, and I appreciate we're at the end, so a few have signed off, but the majority, frankly, were within the next 6 months, which it's funny, I would have actually, if I was to guess before the poll started, I would have been with you. I thought a lot more would be there, and that's really what we see. Just to finish up, Jeremy, thank you again for your time. As always, pleasure to hear your insights. And I just want to encourage anyone, again, we'll be sending out the video on this within the next 24 hours. If anyone has any questions at all, please get in touch with us. And I'm happy to put people directly in contact, obviously, with Jeremy to provide his expert advice. Jeremy, anything left for you, sir?
No, just thank you very much, and yeah, I'm happy to help. You know, generally with ongoing conversations about any of the markets overall or strategies going forward.
Thank you. All the very best, and hope to see you again soon. Take care.
Thank you.
Bye-bye.